Are you curious about knowing the differences and similarities between the 2023 bank collapses to 2008? Then you have landed in the right place, as today we will be discussing everything about it. So before getting into it, let's have a look at what really happened with these banks here in 2023. There has been a lot of focus on the banks lately. Let's start by looking at what has happened. It all started with Silicon Valley Bank, which went bankrupt in mid-March 2023. The US government had to intervene and later decided to establish a full rescue plan. Next, the smaller bank Signature Bank followed suit. Signature Bank was also taken over by the authorities. The First Republic ran into trouble where something quite extraordinary happened, namely that some of the largest American banks came together to save the bank. 11 major banks put more than $200 billion into the First Republic to save the bank. This is an expression of the fact that no one in the sector, not even competitors, are interested in others going bankrupt. First Republic alone fell by 33% last Friday, meaning that the stock price landed at just over $23. Just 14 days ago, the stock price was at $115 per share. Do you guys know that Obama made some restrictions on banks after the financial crisis? But Trump took away these restrictions when he became president. If he didn't, there are very good possibilities that SVB wouldn't have collapsed. So Biden is now trying to implement restrictions again. What actually happened to Silicon Valley Bank and how could it go so far? The crash occurred because Silicon Valley Bank ran into liquidity problems. It all started with a lot of savings during COVID-19 and Silicon Valley Bank had more money standing over than ever before. The bank invested these funds, which is common, but primarily in long-term bonds. Interest rates have risen significantly in the last year, and when interest rates rise, bond prices often fall, which is also the case now. That means that the bonds that Silicon Valley Bank invested in have fallen significantly in value. As Silicon Valley's customers began to use their savings, the bank had less and less liquidity, which resulted in the bank being forced to sell a large part of its bonds. This still resulted in a loss of $1.8 billion. The big drop was rumored and made Silicon Valley Bank's customers nervous. This meant that even more people withdrew their money from the bank, and the bank ended up in even greater liquidity problems and had to acknowledge a collapse. So the crisis started in the USA, but the uncertainty quickly spread to Europe, where the Swiss major bank Credit Suisse got into big problems. Credit Suisse in crisis brought by rival. Swiss bank UBS bought its rival Credit Suisse. This means that Switzerland's largest bank, UBS, is buying Switzerland's second largest bank, Credit Suisse. Switzerland's president describes the acquisition as the best possible solution for restoring confidence in the financial system. However, the purchase is seen as a necessary emergency plan. UBS is paying 0.76 Swiss francs per share in Credit Suisse, totaling 3 billion Swiss francs, which is not a good deal for Credit Suisse shareholders. Credit Suisse also came under liquidity pressure as many bank customers began to withdraw their money. But as mentioned before, of course, earlier, no one, not even competitors, is interested in other banks going bankrupt. Now that we all know about the bank collapse, let's dive in and compare 2023 bank collapses to 2008. In 2008, the global financial crisis saw the collapse of several major banks, leading to a worldwide economic recession. Now, in 2023, we are seeing a similar trend with the collapse of several banks around the world. So, how does the current situation compare to the 2008 financial crisis, and what can we expect moving forward? First, let's take a look at the causes of the 2008 financial crisis. The collapse was triggered by the bursting of the US housing bubble, which led to a wave of defaults on subprime mortgages. These defaults then spread to other sectors of the economy, leading to the widespread panic among investors and a credit crunch. In contrast, the causes of the 2023 collapses are more varied. While the COVID-19 pandemic has certainly played a role, other factors such as political instability, low interest rates, and high levels of debt have also contributed to the current situation. Despite the different cases and causes, however, there are some striking similarities between the 2008 financial crisis and the current situation. One of the most obvious is the domino effect, in which the collapse of one bank can trigger the collapse of others. In 2008, the collapse of Lehman Brothers sent shockwaves through the financial world, as other banks began to worry about their own exposure to toxic assets. Similarly, in 2023, the collapse of one major bank can have far-reaching consequences for the entire financial system. Another similarity is the role of government intervention. In 2008, governments around the world stepped in to bail out struggling banks. in order to prevent a total collapse of the financial system. Now, in 2023, we are seeing similar measures being taken, with governments injecting massive amounts of capital into struggling banks. However, there are also some key differences between the 2008 financial crisis and the current situation. One of the most important is the level of public awareness and understanding. In 2008, many people were caught off guard by the sudden collapse of any major banks, and there was a widespread sense of confusion and panic. Now, however, there is a greater level of awareness and understanding about the risks and vulnerabilities to the financial system. This means that people are better equipped to prepare for potential bank collapses, and there is less likelihood of widespread panic. Another key difference is the level of regulation in the financial sector. In the wake of the 2008 financial crisis, governments around the world implemented a range of new regulations aimed at preventing similar collapses in the future. These regulations have helped to shore up the financial system and reduce the risk of bank failures. However, some experts argue that these regulations may have also contributed to the current situation by making it harder for banks to operate and make profits in a low interest rate environment. This has led to some banks to take on riskier investments in order to maintain their profits, which could be a contributing factor to the current wave of bank collapses. Despite these differences, the current situation is still a cause for concern. The collapse of major banks can have far-reaching consequences for the economy and the livelihoods of millions of people around the world. As such, it is important for governments and financial institutions to take swift and decisive action to address the root causes of the problem. Some solutions that have been proposed include increasing regulation of the financial sector, encouraging banks to diversify their investments, and providing any greater support for small businesses and individuals who may be adversely affected by bank collapses. Ultimately, the current situation highlights the need for greater transparency and accountability in the financial sector. Banks must be held to a high standard of conduct and must prioritize their needs to their customers and the broader economy over their own profits. While the current wave of the bank collapses may have different causes and consequences than the 2008 financial crisis, there are still many similarities and lessons to be learned. By working together to address the root cause of the problem and ensure greater transparency and accountability in the financial sector, we can help to prevent similar crises from occurring in the future. The world has subsequently been battered by the pandemic, the Ukraine war, the inflation shock, and the current banking crisis, but the way they're still all genetically linked to the failure of policymakers to deal with contingent risks arising from 2008, world financial stability remains deeply challenged by weak global growth potential, compromised monetary policy, and badly damaged fiscal finances, a leftover from 15 years ago. Bank balance sheets are still undergoing repair, financial confidence remains fragile, and the ability to cope with the new shocks that the Silicon Valley Bank collapse and Credit Suisse troubles remains severely limited. Global policymakers are running out of time and obvious solutions, but they need to be quick before the contagion gets out of control. The crisis of 2008 still has a very strong resonance today. It's not hyperinflation that we need to worry about, but the longer-term danger of deflation if the world slips back into recession after central banks overreacted with higher interest rates than necessary. In the rush to raise rates in the US and Europe, the central banks scored their own goal, hitting the interest rate-sensitive components of banks' capital and reserves, leaving potential holes in balance sheets. It was one of the main factors which brought down SVB, whose US Treasury and mortgage-backed bond holdings were hit as the Federal Reserve continued to tighten policy. The problem now is that it has opened a Pandora's box of contagion risks, with viral uncertainty spilling over into the other banks, reminiscent of the mood of 2008. There is not a lot of policymakers can do about it other than throw more money at shoring up beleaguered banks' balance sheets and reversing the recent round of interest rates hikes. The last thing we need is a global recession and all associated risks of economic pain and market meltdown. It's time for central banks to mend their ways and to turn over a new leaf. There isn't the same system-wide problem that there was in 2008, where the banks around the world suddenly found they were exposed to rotten investments in the US housing market. This led to enormous government bailouts and a global economic recession. US President Joe Biden pledged to do whatever it takes to ensure the safety of the banking system. Since then, banks have been ordered to hold more capital, and regulations around risk have been tightened. So most experts believe the impact of these current troubles will be contained. Still, the world of banking is extremely complicated. It can be hard to identify where new fragilities might lie until the system comes under pressure, as it did when Liz Truss's government surprised the markets with its new economic strategy in September, and as now with higher interest rates and wavering confidence. Moreover, nervousness about the health of banks is often contagious, and if people start to worry about their deposits, they can move them at the click of a mouse. Even if we don't see the total breakdown in trust that characterized the financial crisis, we could still see regulators toughening up the rules further and banks pulling up back on their willingness to lend. That could put a chill on the global economy at a time when it could do without it. So that was it for today, guys. We hope you liked the video. Before going, make sure to like, subscribe, and press the bell icon so that you never miss another video. Till then, goodbye.